Adobe might be one of the most overlooked AI stories in the market right now. While names like NVIDIA and Microsoft grab all the headlines, Adobe quietly reported record revenue last quarter, almost $6 billion, and raised its full-year targets. Yet the stock still trades around $335 a share, nearly 25% below its 2021 peak. Welcome to the Adobe Stock Deep Dive. So why hasn't the market rewarded Adobe? Investors have two big concerns. First, that generative AI tools like Midjourney or Canva could make Adobe's professional software less relevant. And second, that rising AI compute costs could start eating into margins. Those fears have kept valuation multiples near 5-year lows, even though the company's core business continues to expand. In its most recent quarter, Adobe generated $5.99 billion in revenue, up 11% year over year, and posted a non-GAAP operating margin of roughly 46%, among the highest in enterprise software. The digital media segment, which includes Creative Cloud and Document Cloud, brought in about 3/4 of total revenue and grew 12%. Within that, Creative Cloud remains the anchor, used by an estimated 80% of professional designers and agencies worldwide. Here's the part the market might be missing. AI isn't disrupting Adobe's model, it's reinforcing it. Adobe's Firefly system is fully integrated into Photoshop, Illustrator, and Express, letting creators generate or modify images inside the same workflow. That's powerful because Firefly is trained exclusively on licensed Adobe stock material, meaning all generated images are safe for commercial use, something most other AI models can't guarantee. For large enterprises, that compliance advantage matters more than speed alone. Adobe also isn't giving AI away for free. Every Creative Cloud plan now includes a monthly allowance of generative credits, which are used each time someone runs an AI feature. Once those credits run out, users pay extra. That means AI adoption directly drives additional revenue, turning a potential cost center into a pricing lever. It also helps offset higher GPU and compute expenses as Firefly usage scales. Beyond Creative Cloud, Acrobat and the wider Document Cloud are seeing strong adoption, now reaching around 650 million active users. Firefly is being built into Acrobat too, allowing users to summarize long PDFs, extract key points, and even generate emails or reports automatically. Meanwhile, Experience Cloud, Adobe's marketing and analytics platform, is linking AI-generated content directly to campaign targeting and personalization. That integration between content creation and customer data is what's keeping large brands locked into Adobe's ecosystem. Despite all of this, the stock remains cheap relative to peers. At $335 per share, Adobe trades around 16 times forward earnings and about 13 times forward EBITDA, a deep discount to the software sector average of roughly 20 times. The company still holds close to $5 billion in cash, with limited debt and consistent buybacks. Even after investing heavily in AI infrastructure, free cash flow remains above $8 billion a year. That combination, growth, profitability, and balance sheet strength, is rarely priced this low in large cap tech. But there are risks. If AI compute costs rise faster than credit monetization scales, margins could compress, pulling valuation back toward the $400 range. Competition at the lower end from Canva and Figma could also erode new user growth, even if professionals remain loyal. And finally, Adobe's pricing power has limits. Creative Cloud subscriptions have already seen several increases, so pushing further could trigger churn among smaller creators. So, while the downside looks limited, growth execution still matters. At around $335 per share, Adobe is being priced as if its best growth years are behind it. But when you look at the company's actual profitability and recurring revenue model, that discount doesn't make much sense. Let's go through 3 ways to frame the valuation: the earnings multiple, enterprise value, and a conservative discounted cash flow model to see how those numbers stack up. Adobe guided for roughly $20.80 in non-GAAP EPS for fiscal 2025. At $335, that's about 16 times forward earnings, a level usually reserved for mature, cyclical companies, not for a software firm still growing revenue in double digits. Even if we apply a modest multiple of 20 times, which is still below Adobe's 5-year average of around 27 times, the implied price jumps to roughly $415 per share. Next, looking at enterprise value relative to EBITDA, Adobe trades around 12.8 times forward EV over EBITDA. Comparable peers, Salesforce, Autodesk, ServiceNow, average near 20 times. Even adjusting for Adobe's slightly slower top-line growth and conservative spending outlook, a fair midpoint multiple would be 16 times. Apply that to Adobe's expected FY25 EBITDA of roughly $11.7 billion, and the implied enterprise value comes out near $187 billion. Subtract net debt, divide by the current share count, and that yields an equity value of about $485 per share. Finally, a DCF helps translate those profits into long-term intrinsic value. Start with Adobe's trailing 12-month free cash flow of about $8.5 billion. Assume a 6% annual growth rate for the next 5 years, well below its historical 12 to 14%. After that, taper to a 2% terminal growth rate to reflect economic normalization. Discount those cash flows using a 10% weighted average cost of capital, slightly above Adobe's own blended cost, to keep things conservative. Under those assumptions, the present value lands around $410 per share. That gives us a clear range: $410 on the defensive end, roughly $470 in a normalized environment. So, for investors who can look beyond the next quarter's margins and focus on the 5-year horizon, Adobe still looks undervalued, underappreciated, and fundamentally positioned to keep compounding quietly in the background of the AI boom.